July 2, 1997, a single currency collapses in Thailand. Within 6 months, half the world is burning. This is the story of how one small crack destroyed economies worth trillions, erased decades of progress in days, and taught the world a lesson it's still learning today. This is the Asian financial crisis. The year is 1990. Asia is rising. Not slowly, not cautiously, like a rocket. Thailand, Indonesia, South Korea, Malaysia, the Philippines. These aren't just countries anymore. They're miracles. The world calls them the Asian tigers, and everyone wants a piece. For 15 years, these nations grow at rates the West can only dream of. 7%, 8%, 10% annual growth. Skyscrapers pierce the clouds in Bangkok. Factories multiply across Jakarta. Seoul becomes a tech powerhouse. Foreign investors pour billions into these economies. Banks hand out loans like candy. Everyone believes the boom will never end. But beneath the glittering surface, something is rotting. These economies are built on borrowed money. Borrowed dollars, to be precise. Companies take loans in US currency because interest rates are lower. Governments peg their currencies to the dollar to attract foreign investment. Seems brilliant, until it isn't. Thailand is the first domino. By 1997, Thai banks are drowning in bad debt. Real estate developers borrowed billions to build offices nobody needs. The property market is a bubble ready to pop. Foreign investors start to notice. They start to worry. Then they start to pull their money out. The Thai government tries to defend its currency, the baht. They spend billions of dollars from their reserves, buying baht to keep its value stable. It's like trying to hold back the ocean with a bucket. On July 2, 1997, they give up. The baht floats freely. Within hours, it loses 17% of its value. Within weeks, it's down 50%. But here's what nobody expected. The panic doesn't stop at Thailand's borders. Investors look at Indonesia, Malaysia, the Philippines, South Korea. They see the same problems. Too much debt. Too many bad loans. Currencies pegged to the dollar. And they run. All at once. Money floods out of Asia faster than it came in. Indonesia is next. The rupiah collapses. Then it collapses again. By January 1998, it's lost 80% of its value. Imagine waking up and your life savings can buy 1/5 of what it could yesterday. Riots break out in Jakarta. Supermarkets are looted. President Suharto, who ruled for 32 years, is forced to resign. South Korea, one of Asia's strongest economies, teeters on the edge of bankruptcy. The government has only enough foreign currency reserves to pay for a few weeks of imports. Samsung, Hyundai, massive conglomerations called chaebols are bleeding cash. The one crashes. Unemployment explodes. Middle-class families lose everything overnight. Malaysia's Prime Minister Mahathir Mohamad calls currency traders rogue speculators and accuses them of economic warfare. The ringgit plunges anyway. Hong Kong's stock market crashes 23% in 4 days. The Philippines, still recovering from decades of political instability, watches the peso crumble. This isn't just about numbers on a screen. This is about people. A factory worker in Seoul loses her job. A farmer in rural Indonesia can't afford rice. A family in Bangkok sells their home for pennies. Across Asia, 40 million people fall back into poverty in less than a year. And the fire is spreading. Russia, already economically fragile, defaults on its debt in August 1998. Brazil's economy shakes. Latin America trembles. Wall Street panics. The hedge fund long-term capital management, run by Nobel Prize winners, nearly collapses and threatens to take down the entire American financial system. The world is connected in ways nobody fully understood. A currency crisis in Bangkok becomes a global emergency. The question everyone is asking, how did this happen? How did the miracle turn into a nightmare so fast? To understand the wildfire, you need to understand the fuel. And the fuel was everywhere. Debt. Not just any debt. Dollar-denominated debt. Money borrowed in US currency by companies and governments across Asia. In the early 1990s, this seemed like genius. US interest rates were low. Asian businesses could borrow dollars cheaply, invest in growth, and repay the loans easily as their economies expanded. Governments encouraged it. They kept their currencies pegged to the dollar at fixed rates. $1 equaled 25 Thai baht. Always. This made borrowing predictable, safe, or so they thought. But there was a hidden trap. When your currency is pegged to the dollar and you owe billions in dollars, you're betting everything on that peg holding. If your currency falls, your debt explodes. A Thai company that borrowed $1 million suddenly owes twice as much in baht after the devaluation. And they still have to pay in dollars. The banks were the biggest gamblers. Thai banks borrowed short-term from foreign lenders and used that money to give long-term loans to local property developers. It's called maturity mismatch, and it's financial Russian roulette. When foreign lenders wanted their money back, Thai banks didn't have it. The whole system seized up like an engine without oil. Real estate was another bomb waiting to explode. In Bangkok, developers built office buildings and luxury condos at a frenzied pace. By 1996, Bangkok had more unoccupied office space than the entire city of Los Angeles. But banks kept lending. Property prices kept rising. Everyone assumed the boom was permanent. Then came the interest rate shock. In 1994, the U.S. Federal Reserve started raising interest rates to fight inflation. Suddenly, borrowing dollars became expensive. Money that had been flowing into Asia started flowing back to America, where returns were better and risks were lower. The tide was turning. Currency speculators sensed blood in the water. These are traders who bet against currencies they think are overvalued. George Soros famously broke the Bank of England in 1992 by betting against the British pound. Now speculators targeted Asian currencies. They borrowed baht, sold them for dollars, waited for the baht to fall, then bought them back cheaper and pocketed the difference. Thailand tried to fight back. The central bank spent $23 billion of its reserves defending the baht. They raised interest rates to make holding baht more attractive. But it was hopeless. On July 2nd, they surrendered. The baht plunged. The crisis was officially born. What happened next was pure contagion. Contagion is when panic in one market spreads to others. Investors didn't just pull money from Thailand. They pulled it from every emerging market that looked remotely similar. Indonesia, Malaysia, the Philippines, South Korea. It didn't matter if their fundamentals were different. Fear is contagious. Indonesia's situation was especially catastrophic. President Suharto's regime was riddled with corruption and cronyism. Banks lent to companies owned by Suharto's family and friends, regardless of whether those companies were profitable. When the crisis hit, these loans went bad. The banking system collapsed. The rupiah went into free fall. By January 1998, Indonesia's economy was in ruins. Inflation hit 77%. The price of rice, the staple food, quadrupled. People couldn't afford to eat. Riots erupted. Ethnic Chinese, who dominated business, were scapegoated and attacked. Over 1,000 people died in the violence. Suharto, after 32 years in power, resigned in May 1998. South Korea's crisis was different but just as severe. The chaebols, giant family-owned conglomerates like Samsung and Hyundai, had borrowed heavily to expand. They were too big to fail, or so everyone thought. When the one collapsed, their debts became unpayable. Several chaebols went bankrupt. The government was forced to seek a $57 billion bailout from the International Monetary Fund, the largest in history at that time. The IMF. This is where the story gets controversial. The International Monetary Fund is supposed to be the world's economic firefighter. When countries face financial crises, the IMF provides emergency loans. But those loans come with conditions. Strict conditions. The IMF demanded that Asian countries cut government spending, raise interest rates, close insolvent banks, and open their economies to foreign ownership. The idea was to restore confidence. But the medicine felt like poison. High interest rates crushed businesses. Spending cuts deepened the recession. Unemployment soared. Critics called it economic colonialism. Indonesia, Thailand, and South Korea had no choice. They needed the money. They accepted the terms. But the social cost was staggering. In South Korea, unemployment quadrupled. Families sold their gold jewelry to help the nation pay its debts. It was a national humiliation. The fire was no longer contained to Asia. By mid-1998, it was burning across continents. Russia was next. The Russian economy, already weakened by corruption and falling oil prices, collapsed in August 1998. The government defaulted on its debt. The ruble crashed. Russians who had finally started to see prosperity after the fall of the Soviet Union were back to square one. Russia's default sent shockwaves through Wall Street. Long-term capital management, a hedge fund managed by brilliant economists and Nobel laureates, had bet heavily that markets would remain stable. They were wrong. LTCM lost $4.6 billion in a matter of months. The fund was so interconnected with major banks that its collapse threatened the entire U.S. financial system. The Federal Reserve orchestrated a private bailout. Major banks contributed $3.6 billion to save LTCM. It was a wake-up call. The global financial system was far more fragile than anyone realized. A crisis in Thailand had nearly destroyed Wall Street. Latin America felt the tremors. Brazil, Argentina, and other countries faced capital flight as investors fled emerging markets. Brazil burned through $30 billion defending its currency before finally letting it float in January 1999. The real lost 40% of its value. The region slipped into recession. Even Hong Kong, with its massive reserves and strong institutions, was under attack. Speculators bet against the Hong Kong dollar. The government fought back with an unprecedented move. They used $30 billion to buy stocks in the Hong Kong stock market, directly intervening to prop up prices. It worked, but it was a desperate gamble. Back in Asia, the human cost was unbearable. In Indonesia, 40 million people fell below the poverty line. Schools closed. Hospitals ran out of medicine. Malnutrition spiked. In Thailand, construction workers who had migrated from rural areas to Bangkok returned to their villages, jobless and desperate. In South Korea, suicide rates soared as breadwinners faced unemployment and shame. But amid the ruins, something unexpected happened. Countries started to rebuild, and they rebuilt smarter. South Korea dismantled the chaebol system. Banks were forced to become transparent. Bad debts were written off. Corporate governance improved. The chaebols that survived, like Samsung, became leaner and more competitive. Thailand implemented financial reforms. Banks were recapitalized. Regulations were tightened. The property bubble was deflated painfully but permanently. Indonesia, after Suharto's fall, transitioned to democracy. It was chaotic, but it was progress. The country began to modernize its institutions and fight corruption, slowly but steadily. Malaysia took a different path. Prime Minister Mahathir rejected the IMF. Instead, he imposed capital controls, restricting the flow of money in and out of the country. Economists predicted disaster. But Malaysia recovered just as fast as countries that followed the IMF playbook. It became a case study in alternative crisis management. By the year 2000, the worst was over. Growth returned. Stock markets recovered. Currencies stabilized. But Asia was changed. The era of reckless borrowing and pegged currencies was over. Countries learned to build foreign currency reserves as a buffer against future crises. By 2026, Asian nations hold trillions in reserves, a direct legacy of 1997. The crisis also gave birth to new institutions. The Chiang Mai Initiative, established in 2000, created a network of currency swap agreements between Asian countries. If one faced a crisis, others would provide emergency liquidity. Asia decided it couldn't rely solely on the IMF. It needed its own safety net. The lessons weren't just regional. The crisis exposed the dangers of globalized finance. It showed how quickly confidence can evaporate and how interconnected the world had become. A problem in one small country could cascade globally in days. This realization shaped how economists and policymakers thought about financial stability. But not everyone learned the lesson. Just a decade later, the 2008 global financial crisis would erupt, triggered by similar problems. Excessive debt, risky lending, complex financial instruments that nobody fully understood. and blind faith that markets always correct themselves. The parallels were chilling. So what does 1997 mean for us today? Why does a crisis that happened nearly 3 decades ago still matter? Because the forces that caused it are still with us. Debt, speculation, interconnected markets, and the belief, always dangerous, that this time is different. Let's talk about debt. In 1997, Asian countries owed billions in foreign currency. Today, global debt is higher than ever. Governments, corporations, households, everyone is leveraged. Emerging markets still borrow in dollars. When the dollar strengthens, their debt becomes harder to repay. The same trap that caught Thailand in 1997 still exists. Let's talk about contagion. In 1997, panic spread from country to country in weeks. Today, with high-frequency trading and instant global communication, panic spreads in seconds. A crisis can go global before policymakers even wake up. The speed of modern finance is both a blessing and a curse. Let's talk about warning signs. Before 1997, everyone ignored the red flags. Bad loans, overvalued currencies, asset bubbles. Today, we have better data and smarter economists. But we still ignore warning signs when it's profitable to do so. Human nature hasn't changed. The Asian financial crisis taught the world that growth built on unstable foundations will eventually collapse. It taught us that currencies pegged to foreign powers are vulnerable. It taught us that financial systems are only as strong as their weakest link. And it taught us that when crisis strikes, the poor suffer first and suffer most. But it also taught resilience. Asia didn't just recover, thrived. Today, Asia is the engine of global growth. China, India, Southeast Asia. These are the regions shaping the 21st century. The crisis of 1997 was a painful teacher, but the lesson stuck. South Korea went from near bankruptcy to a global leader in technology and culture. K-pop, Korean dramas, Samsung, Hyundai. These are symbols of a country that rebuilt itself from the ashes. Thailand became a manufacturing hub and a tourist destination that welcomed 40 million visitors a year before the pandemic. Indonesia, despite its challenges, is now the world's 4th most populous nation and a rising economic power. The crisis also showed the limits of international institutions. The IMF's response was controversial and remains debated today. Did the austerity measures help or harm? Could there have been a better way? These questions shaped how the IMF approaches crises now. During the 2008 crisis, the IMF was more flexible, more willing to allow stimulus spending, more aware of the social costs of its policies. For investors, 1997 was a brutal reminder that emerging markets are risky. High returns come with high risk. Diversification matters. Understanding the fundamentals of an economy matters. Blindly following the crowd leads to disaster. These lessons are taught in every business school now, but they were learned the hard way in 1997. For ordinary people, the crisis was a reminder that global economics isn't abstract. It's personal. When currencies collapse, people lose jobs. When banks fail, savings disappear. When governments cut spending, services vanish. Economics is about people, not just numbers. Nearly 30 years later, the 1997 Asian financial crisis remains one of the most important economic events of the modern era. It was a turning point, a moment when the world realized that globalization meant shared prosperity but also shared risk. That rapid growth could turn into rapid collapse. That confidence, once lost, is hard to rebuild. The wildfire of 1997 burned half the world. But from the ashes, stronger economies emerged. Smarter regulations were born. A new understanding of global finance was forged. The scars remain, but so does the resilience. As we look at the world today, with rising debt, geopolitical tensions, and climate change adding new layers of risk, the lessons of 1997 have never been more relevant. History doesn't repeat, but it rhymes. And the rhyme is clear. Build on solid foundations. Manage debt wisely. Don't ignore warning signs. And when crisis comes, protect the most vulnerable first. The story of the 1997 Asian financial crisis isn't just history. It's a blueprint, a warning, and a testament to the power of resilience. If you found value in this journey through one of history's most dramatic economic collapses, don't stop here. Subscribe, hit the bell, and join us as we continue exploring the moments that shaped our world. Because the past isn't behind us. It's beneath us, shaping every step we take into the future.